So if you have a pension and you're watching this video, you're probably a federal employee or federal retiree, and you're going to have a pension. So smart tax planning, proactive tax planning needs to start now, or else you could end up paying higher taxes. That's what we're going to talk about next. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we help federal employees plan for a better retirement. If you need personalized help, go to christycapital.com, click Talk to an Advisor. Smart tax planning helps make sure that you don't overpay more in taxes than you absolutely have to. And here's where you can run into trouble. Pensions push your income higher than the average retiree who doesn't have a pension. When you factor in your pension, your Social Security, the required minimum distributions that you'll be forced to take out of your traditional TSP or traditional RA, it can push you up the tax bracket higher than you were thinking. Another problem with a large pension and RMD is that your Medicare premiums can go up. At age 65 or at retirement, if it's after 65, you have the option of turning on Medicare, if you want to. But the premiums are based on your income. So if you have a pension, Social Security, you have traditional TSP or IRA, and you're forced to take required minimum distributions, it can cause your Medicare premiums to go up. So how do you fix this? We need to find a way to smooth out your income. So let's look at a case study here about how to smooth out your income so that you don't overpay in certain years. Here's a couple where this is showing their taxable income per year. You can see in 2025, the darker blue is the FERS retirement income. And then a little bit of red is retirement account withdrawals, to meet their living expenses. You can see in 2028, the light blue color begins, which is Social Security. So in this case, they are no longer having to take retirement account withdrawals. The Social Security is meeting that need. You'll see in 2038, the darker green comes in, and those are the required minimum distributions, which are the mandatory amounts that you have to take out of your traditional account. And you can see when that happens, all the income kicks up. The green income line there represents the 22% bracket. So in some of the early years, this couple is actually in the 12% bracket. But you can see in 2038 and after, you're now well up into the 22% bracket. And in 2042, you start going up into the 24% bracket. And then you can see out in 2053, you get bumped up into the 32% bracket. And then around 2055, you see how the tax bracket line sharply goes down? And that's because we are showing one of the spouses passing away, and the remaining spouse is now going down to the individual income tax bracket. And those tax brackets increase rates on lower income levels. So you kind of move up the bracket even faster. But keep in mind, the required minimum distributions are just as big. The pension goes down some because of the survivor benefit. Social Security goes down some because of the loss of one of the Social Securities, but the required minimum distributions usually stay about the same. And you actually are showing in 2057, this person is going to be in the 35% tax bracket. This is an example of someone's income not being smooth. And you can lose control of your income and thereby lose control of your tax bracket. So let's look at a way to fix this in this next scenario. We are doing some Roth conversions to the top of the 22% bracket. You can see in year 2025, some of the yellow, that's the Roth conversion amount. The Roth conversions are filling up the 22% bracket. This means on some of the conversion, you'll pay 12%, and some of it you'll pay 22%. In our example, we're doing 15 years of Roth conversions, maxing out the 22% bracket. Once we're done in 2040, you'll see the yellow Roth conversions go away. There's another color you don't see, the darker green that illustrated required minimum distributions. This is illustrating Roth converting everything where there's no traditional money left and therefore no required minimum distributions. In this example, there'll be a few years like 2041 and 2044 where you'll actually be in the 12% bracket, and there'll be a few years where you'll be in the 22% bracket. The thing here is smoothing out your income. We are illustrating that we're not going in the 32% bracket ever. And even in 2055, when one spouse dies, we're still in those lower tax brackets, smoothing out income by paying a little bit more taxes sooner, but in a lot of cases, it can mean that you pay a lesser amount in taxes overall in your lifetime. You can see over on the right side that it says the amount of taxes without the strategy versus the taxes with the strategy. This person is estimated to save $503,000 in taxes by paying them earlier on the smaller balances and thereby paying less taxes in the long run. In this example, you'll see this is maxing out the 24% bracket and converting all the way up until the top of that 24% bracket. You see, it doesn't take 15 years now. Now it only takes 6 years. On the right side, you'll see It's $428,000 in tax savings over not Roth converting anything. So not quite as much savings as the last time. And that makes sense because we're converting and paying 24% on some of that money instead of only paying 22%. So you may quickly look at this and say, maxing out the 22% bracket would be a better option because you save more taxes. And that actually makes a smoother income, and mathematically that would be true. The only thing that would make the 24% Roth conversion strategy make sense is if you think taxes are going to get worse, and so you need to pay off the tax man faster. This definitely lets you pay it off faster. If we illustrated tax rates going up in the later years, I think this strategy might show better results than the first. But you get the idea of smoothing out your income by going ahead and doing some Roth conversions, and paying taxes on some of the money now can help in the long run. Some people fall in love with the fact that they're in the 12% bracket for the first few years of retirement, not realizing that the later years of life, they're going to potentially be in the 32 or 35% bracket. Doing proactive planning can help fix this. And if you have a pension, there's all the more need for it because income tax brackets are getting filled up by that pension. And so you can have your income pushed up into brackets, higher brackets sooner, just because of that pension. If you're watching this, you probably have a pension, so this is something that you should be looking at. If you've got $500,000 or more in your TSP, then you potentially have issues in your 70s and 80s. If you want help implementing our strategy for success that looks like this, please reach out to us at ChristyCapital.com. Click Talk to an Advisor. Do you want to watch a video of the 7 critical tax years to plan for in retirement so that you don't overpay? Check out this video right here. My name is Mel Stubbs. These strategies are so important, so even if you don't use us to get the help, make sure you're getting the help from somebody. I'll see you on the next video.